So here, this particular analysis is not a common size balance sheet. It's a balance sheet stated as a percent of sales. So just like we divided every item in the income statement by sales, we did the exact same calculation for the balance sheet. So to interpret this, we could say, I'll just pick a number, that number. So in the year 2016, receivables represented 20% of sales. That's what this means. What we look for is a progression. So we look at cash. Cash is increasing over time, which shows good things. We're starting to generate excess resources. We look at receivables. It didn't change at all. And you might say, well, okay, the company's growing and receivables is the same. That must be good. It's okay, right? The reason I say okay is I would love to see that our practices improve, that we could collect more receivables faster. So as our sales grow, we're able to collect faster and faster. Here, we don't. It's pretty much flat. So that's not all that impressive. It's not bad, but it's not impressive. Same thing with inventories. Inventories are also flat. You would hope that as you grew sales, that the amount of inventory you need to have on hand to support that sales would go down. In other words, you're more efficient with your inventory, but you're not. Here, not particularly meaningful. Other change by 1%. I'm not going to sweat it. Then we have current assets growing, but most of the assets growing is because of what is going on in cash, right? So it's a good thing. Next, we'll look at fixed assets. Again, flat. Again, okay, but not great. I'd love to be able to get more leverage from our scale. So our factories are more efficient, our warehouses are more efficient. So our fixed asset investment as a percent of sales should drop. It's not. So it's okay. Goodwill and intangibles, see it going down. When we see a pattern like this, it probably means that we acquired something that amortizes. You may recall that word amortize means that we buy an intangible assets, like we purchased a license to use a patent. And there's 10 years left on the patent. So we pay $1 million. Each year, we knock it down by 1/10 of $1 million or $100,000. So this is an example. We see a very regular drop off. It's probably some amortization. The reason I say that is we do not amortize goodwill. Goodwill, which is the result of us acquiring another company at a premium over their fair value. Goodwill stays at that level unless you know otherwise. When the value of that acquisition drops, then we do a write-off. But we don't, as a matter of systematic reduction, like depreciation or amortization, we don't make goodwill go down, 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 down. We keep it at the same level unless it is impaired. So that's how goodwill works. Next is on the liability side. Again, we see a lot of flat things. Accounts payable are flat, notes payable are flat, everything's flat. And that means that our amount of financings are also stable. When we look at long-term debt, you see a nice pattern. It went from 13% down to 10%. So the profit we're earning, we're using to pay off long-term debt. So it's gone down from 13 to 10, which corresponds to an increase in shareholders' equity. So shareholders' equity is rising, debt is going down, the risk in the company therefore is lower. So this green section here, what I just covered with you, just in looking at this particular example. All right, next let's look at certain elements of the cash flow, specifically to get to free cash flow. We have net income, and we see it's stable at 9%, jumping at the very end to 10. Then we see that depreciation and amortization, pretty flat between 3 and 4. CapEx is 5%, no big changes there. Our working capital, we're spending less on increases in working capital over time. So our free cash flow is flat. Again, I don't mind making money. I don't mind getting cash flow. In this particular case, it's flat, so we'll take it. But if we were managing our business more aggressively, we should have seen higher margins. We should have seen more frugal use of assets, which means our investments in assets would decline. But we didn't see that. We're seeing flat. So that it is what it is. It's okay. This purple section means that there's another way to do common sizing a balance sheet. Again, I'll show this in class. The other way to do common sizing is to divide all the line items in the balance sheet by total assets, not total revenue. This particular method would then yield a different analysis. It shows the composition. Composition is what percent of my assets are invested in Inventory. What percent are invested in fixed assets? You see how that works. It's a composition. So it shows where's our assets. The other side of the balance sheet, it shows how did we finance it. It shows the percent of assets that were financed through liabilities and the percent of assets financed through equity. So it answers a different set of questions. It may look very similar since they're all percentages, but it's quite different. They're stated as a percent of total assets. Again, the book example did not have it. That's why it's not in this sheet, but we'll do it in class. The green section, or lime green section, are some financial analysis using ratios. We have day sales outstanding. This is how many days it takes us to collect our receivables. Here it's flat. Again, it's okay, but I'd like to be collecting faster. The inventory turn. Turn, I do this with my finger. It means how fast you turn over your inventory. We want to turn fast. We want a high number. In this case, it's flat, 2.5. Next is DSI, day sale and inventory. It means how many days does it take you to sell your inventory on average? Ooh, ugly. 146 divided by 30. That's like 4+ months, almost 5 months to sell your inventory. So there's a problem there. Fixed asset turnover. How much sales do you get given the amount of total assets or total fixed assets you have in place? Here again, it's flat at roughly 4.9 to 5%. Then total assets. How much are we using total assets? Again, it's flat. In normal company scenarios, you'll have some variations to do some analytical observation from it. Our observation here is an observation. It's flat. ROA, return on assets, is flat at 12%. Out of every dollar of assets, how much profit do we make? ROIC is out of every dollar of invested capital, how much money do we make? This will turn out to be an important measure that we'll look at later. ROE, return on equity, out of every dollar of shareholders' equity, how much profit do we make? Here it's declining. Why? It's declining because our retained earnings are going up. So therefore our equity is going up. As our equity goes up, our profit will then be divided by a bigger and bigger number. That's what's driving down some of the ROE. And then economic profit, which is one of these hybrid measures where we look at historical cost in order to get the operating income and tax on it. But then we use measures like WACC, which is a market-based measure, to then compare to a investment charge in order to get to economic profit. Next, we look at times interest earned. This is a very important measure. It just says how safe are we in paying off our interest expense as they become due. So we have a certain amount of operating income. Let's just do the example of 1. If the TIE, or times interest earned, equals 1, that means your interest expense exactly equals your EBIT, your earnings before interest and tax. That's not good. That means for every dollar you earn, you give it all to the bankers or the bondholders. That's no good. So we want this number high. Here it's pretty high. It's between 20 and 25%. That's good. So you're comfortably able to pay your interest. Debt to total capital on a book basis is 15%. Again, we see it declining because we're seeing that debt is going down. We're paying it off. We see debt to capital similarly going down because we're paying off debt. Leverage, and this one is shown by just assets divided by equity. We see that this ratio is also declining because we're seeing that our equity base is getting larger and larger. Finally, we have current ratio, which is a measure of our ability to pay our bills. We're between 4 and 5. That's good news. That means we have 4 to 5 times more current assets than we have current liabilities. We aspire to have more assets than liabilities. And here we're comfortably above what historically is safe. Historically, people have used 2.0 as safe. I've seen and I've run companies below 2.0 without being reckless. So old-fashioned measures would have 2.0. Modern methods of cash management will allow you to manage a little tighter and be below 2.0. Return on equity, this is an example of a decomposition type of analysis where you have one measure, in this case ROE, and it's derived from a component of 3 measures that multiplied by each other gets you to that place. So this decomposition has a formula that ROE equals the net profit margin times the asset turnover times the leverage. So the decomposition says, okay, what happened to ROE? Oh, it's kind of boring, 18, 18, 17, 17. So it's pretty flat. It's going down a little bit, but it doesn't really tell you much about why that happened. If you decompose, then you figure out why. Notice that the profit measures are flat. Our net margin is between 9.4 and 9.5. Not a lot happening there. Then we look at this factor, asset turnover, slower, right? Again, turnover, faster, faster, higher, higher is better, better. Now it's not. So we're slower. That's not good. And then the second thing is leverage. Leverage is going down. So leverage going down, sure, it reduces the risk. But when you use other people's money, that means you use less of your own money. So leverage from the standpoint of return on equity is a good thing. The more leverage, the more you're using other people's money. And so that accelerates your ROE. So here we have a profit number that's not moving. We have a slightly worsening use of assets, which is a negative effect on ROE. And then we have a delevering where we have less debt, which is also a negative impact on ROE. So we can now explain that the drop in return on equity is not because we're making less money on our income statement, but we're using our assets less efficiently and that we're delevering. Therefore, we're not using other people's money to earn money for our own shareholders. So this is a review, hopefully for you guys, and it's now coming clear again, of common size analysis, trend analysis, and ratio analysis. The last page I'll show you relates to some graphics, and it pretty clearly tells you that graph is far more easy to interpret than numbers, than charts with numbers. We had base information given to us in numbers. We do quantitative analysis on trends, on ratios, and then we depict it on this tab with graphs, which kind of tell it very quickly. So here we see, flat year-to-year growth rate. Not excited, but we are growing. So the blue bars here, represent the growth of sales. It is growing. It's just that the rate is not accelerating. So it's okay. Next, we look at profit and profitability, where the bar represents operating income, again, growing because sales are growing, margins are steady. But the profitability, which is a measure as a percent of sales, is flat, right? Not very exciting there either. Next, we have economic profit versus ROIC. Now, this might be less familiar to you, so I'm going to slow down a bit. Economic profit equals the net operating profit after tax, NOPAT. We normally take a shortcut when we derive NOPAT. We take the net operating profit before tax and multiply it times 1 minus the tax rate. Then we subtract from that an investment charge. So NOPAT is how much money did you make from running the business? Got it. That's a number. Next we say, well, how much should you have made? So there's a shortcut here too. It takes the invested capital at book value. So it takes that invested capital, which equals shareholders' equity plus debt plus bonds. Anytime you borrow money from someone whose business it is to lend money, in other words, lenders, you count it as invested capital. So when you add those all together, debt, bonds, which is a form of debt, and equity, add those together and you get invested capital. So that's how much money has been put or entrusted in your business. How much do you expect to make? Weighted average cost of capital represents a percentage that is how much you need to earn. So if we have a asset amount times what you need to earn, you multiply it and it is what we call investment charge. It means how much should you make? If the NOPAT is higher than what you needed to make, the charge, then you're positive. That's called a positive economic profit or positive EVA, economic value added. If it's the other way, you make a certain amount of profit and your investment charge is higher, you're in trouble because your suppliers of capital needed you to make more money than you actually made. This would be an uncomfortable position for senior management to be in because you're disappointing the providers of capital. You don't want to do that. It could be career limiting, right? So that is the idea of economic profit. All right, next is ROIC, return on invested capital. So this one takes the operating profit after tax and divides it by the invested capital, and you get a percentage. Now notice here it's declining. Oh, bad news. But here's a mortal sin. In my days, in my training at Bain, we would never be allowed to draw this graph. I want to show you why, because I want you to not fall for the what we call Time Magazine or sensationalists. I'll show it to you on the right here. So I just recreated the slides here side by side. So I'm going to show you before and after. The before is what we just saw. We saw ROIC. And if my question to you is, how is the company doing? You say, oh, terrible. It's declining, right? The reason that this is like not permitted by Bain, probably other consulting firms too, is if you look at this right axis and we modify it to not start at 14.8 like it is right here, what if I started at 0? Then what happens? We see this. You see this blue line? So this is a more accurate and objective view of how the company is doing. Yes, it is going down, but it's not this dramatic, cataclysmic, oh, the earth is ending scenario of plummeting profit margins. You know, I hate it when I see sensationalist news or people exaggerating results. Yeah, it went down, but it went down a little bit. So I'm not going to like slack off and say it's okay to have declining margins. Quite the contrary, it warrants attention. But let's not exaggerate and sensationalize that this particular graph, by the way, looks like margins dropped by more than half. We started up here, we ended down here. Visually, it looks like, oh, margins have cut in half. That's nowhere near the truth. So this is not legit analysis. So it may be sensationalist. You might be tempted to do it. But if you're showing this to professionals, they're going to say, come on, don't exaggerate. It went down, yes, but not nearly as dramatic as you depict it. You sensationalized it. Oh, by the way, I slipped a moment ago calling this Time Magazine. The reason we call it Time Magazine is this little region right here. Time Magazine would do a little squiggly line. You probably have seen these. They kind of go like this. And it's a signal to you that they're not exactly lying. They're telling you they're being a little deceptive, but they're getting rid of a whole bunch of that vertical axis by compressing it with the little squiggly line. That's how they show it. And again, don't do it. Next is asset turnover. And here you see it declining slightly. We saw this previously when we decomposed ROE. That's not good. We want our asset turnover to be increasing over time, which indicates that we're able to generate more sales for every dollar of assets that we have. We don't really want to be having more assets as a percent of sales, right? That's not where we want to be. We want to have higher turnover. It's frankly a sign of maybe being lethargic and not actively managing your business. Don't want to form a conclusion, but you're starting to hypothesize, like, why is this happening? Last is our measure of what we call the operating cash cycle, which is part of what you may have seen as a cash conversion cycle. It says what is the number of days it takes you to sell your inventory, and then add to it how long it takes you to collect your money. Because the process of making money is I buy inventory or I make inventory, either way, and then I have it ready to sell, and then I sell it, and then I have to wait to get my money from my customer. And the longer that takes, the slower your business turns over money. The shorter it takes, the more tightly you're managing your business. Well, how did this company do? The days to sell, or the DSI, days sales in inventory, is 156. Just do the math for you. Divide 30 into that. That's 5 months. It takes you 5 months to sell your inventory. That's not very fast. You want to be able to make it fast. Let's be a baker. If we're baking baguettes, we better sell those baguettes in one day, right? If we sold our baguettes in 5 months, it would be a pretty hard baguette. So I want you to think in terms of visualizing what's happening in the business so that you could visualize if they're doing well or not. Here, the initial blush is that's not so good. Now, you might say, hey, Larry, you didn't tell me that they make airplanes. Oh, I guess it takes 5 months to make an airplane. I would be more amenable to saying 5 months is okay. So what do? We have a number. It's a little bit suspicious. We don't want to jump to a conclusion, but you certainly want to ask the question, like what's going on? Why is it that it takes you 5 months to sell your inventory? Next, days collect, 73. Divide 73 by 30 days in a month. So it takes you about 2.5 months to collect your inventory. So let me see if I got this right. it takes you 5 months to sell something, and then you have to wait another 2.5 months to get your money. You're now waiting 7 months to turn over your business one time. Not good, right? Normal commercial terms are 30 days. So you'd say, well, I could see it taking 30 days, maybe 31 days, but 73 days? What's going on? Again, there may be something unique in the business that takes you 73 and you're doing well. But in normal commercial business, 30 is okay. Something like 73 is not okay. Don't make the conclusion, ask the question. Maybe they do business with the US federal government, in which case 73 days might be fast, right? So there may be a perfectly viable explanation. Ask the question. Next, revenue per employee. Finally, a good trend. Here we see rising revenues per employee, which is a good sign, means the productivity of the employees has increased. All right, so what we've just done is a refresher on financial statements, ratios and trends, and some graphics. All right, so the book has a handy PDF file that shows the ratios and the description, the formula, and an application. And there's 2 pages of it. I just show it to you here. Again, it's posted on my courses for your reference. So summarizing what we just did is we had a brief, maybe not so brief, review of finance and accounting. In accounting, it was both financial and managerial. And we're going to be using these tools that we've touched on during your year at HALT, and we're going to be applying them to creating budgets and doing analysis to select capital projects and doing forecasting, of course. Thank you, and see you in class.